$700 billion. That is how much foreign wealth was parked in the United Arab Emirates before the first Iranian missile crossed the Gulf. 700 billion held in place by a single assumption: that Dubai would always be safe. On February 28th, that assumption was tested. On March 1st, it was broken. And within 72 hours, the largest capital repositioning since the start of the Ukraine war had quietly begun. I have spent the past 4 weeks tracking where the money is going, not the headlines about panicked tourists and grounded flights, but the actual capital movements. The family office inquiries, the private jet routing data, the real estate transaction shifts. And what the numbers reveal is a redistribution of global wealth that is happening faster than anyone expected. 5 cities are absorbing the outflow, 3 are losing alongside Dubai. Here is where the money is actually moving. Number 1, Singapore. This is the most obvious winner, and the data confirms it. Within days of the first strikes, 2 Indian entrepreneurs in Dubai each attempted to transfer more than $100,000 to Singapore bank accounts. Wealth management advisors in Singapore reported that over half of their clients based in the UAE were seriously considering asset relocation. Family offices began contacting Singapore-based firms at a pace not seen since the pandemic. One corporate service provider said 10 to 20 family offices reached out in a single week to explore moving assets out of the Middle East entirely. Singapore's advantage is structural. It is the only major financial hub in Asia that combines political neutrality, English language legal infrastructure, strong property rights, and no capital gains tax. Before the war, Dubai had been eating into Singapore's market share precisely because it offered similar benefits at lower cost. That competitive advantage has now reversed overnight. The cost of doing business in Singapore is higher, but the cost of being in a war zone is higher still. However, Singapore has a limitation that matters. Its immigration framework restricts the concentration of any single nationality in its workforce. The very demographics that Dubai welcomed, South Asian entrepreneurs, Pakistani family offices, Gulf Arab wealth managers, face a tighter entry path in Singapore. This means Singapore will absorb the institutional capital and the multinational headquarters, but not necessarily the human ecosystem that made Dubai function. Number 2, Hong Kong. For Chinese and Southeast Asian investors who had diversified into Dubai, Hong Kong is the natural repatriation point. It sits within the same time zones, speaks the same financial language, and offers deep capital markets with no capital gains tax on securities. Several asset managers in Hong Kong confirmed that Asian investors are reconsidering their Gulf exposure and moving allocations back. Hong Kong's advantage is speed. Capital can move into Hong Kong listed instruments within hours, while physical relocation to Singapore requires months of visa processing. Number 3, Riyadh. Riyadh, Saudi Arabia's capital, has been building its case as a regional alternative to Dubai for years. Vision 2030 requires multinational companies to establish regional headquarters in Riyadh, and the government has been offering incentives that rival anything Dubai provides. Real estate prices in Riyadh have risen 20 to 35% over the past 2 years, as corporate demand has accelerated. But Riyadh has a critical vulnerability that most analysts overlook. It is inside the same threat envelope as Dubai. Saudi desalination plants, oil infrastructure, and military bases have all been targeted by Iranian strikes in this conflict. Riyadh is safer than Dubai today. But the war has demonstrated that nowhere in the Gulf is truly insulated from Iranian reach. Capital moving from Dubai to Riyadh is diversifying within the same risk zone, not escaping it. Number 4, London. For ultra-high net worth individuals and family offices that prioritize legal infrastructure and generational wealth planning, London remains the default. It has the deepest legal ecosystem for trust structures, the strongest property rights enforcement, and a centuries-old reputation for stability. Post-war Dubai wealth will flow to Mayfair and Belgravia the same way post-revolution Iranian wealth flowed there in 1979. London does not compete on tax efficiency. It competes on permanence. Number 5, Mumbai. India is the largest single source of foreign investment in Dubai real estate, accounting for roughly 18 to 20% of all transactions. Indian nationals are the biggest demographic in the UAE workforce. As Indian entrepreneurs reassess their Gulf exposure, some of that capital will return home. Mumbai's financial district has been modernizing rapidly, and India's domestic consumption story makes it an increasingly attractive place to deploy capital rather than park it abroad. Mumbai will not replace Dubai as a hub, but it will recapture capital that was always Indian in origin. Now for the 3 cities losing alongside Dubai. Number 1, Doha. Qatar is in a uniquely painful position. It is inside the same threat zone as Dubai. Its LNG infrastructure has already sustained missile damage that its national energy company warned could take up to 5 years to repair. And its entire economic model depends on energy exports that transit the closed Strait of Hormuz. Qatar does not have Dubai's diversification into finance and tourism. When the strait closes, Qatar's primary revenue source stops. The capital that was flowing into Doha's financial center and real estate market is now subject to the same risk repricing as Dubai, but with fewer alternative revenue streams to fall back on. Number 2, Abu Dhabi. Abu Dhabi is the capital of the United Arab Emirates, and it holds the Federation's oil wealth and underwrites the entire system. But Abu Dhabi's real estate market, which was growing at 12% in the first quarter, is now caught in the same sentiment shock as Dubai. Its sovereign wealth fund, one of the largest in the world, faces pressure from 2 directions. On one side, there are falling asset values in the domestic market. On the other, rising costs from the war itself. Abu Dhabi will survive because it has reserves measured in decades, but its ambitions to become a global financial center alongside Dubai have been set back significantly. Number 3, Bahrain. The smallest Gulf economy is the most exposed. Its desalination plants have been directly struck by Iranian drones. Its proximity to Iran makes it a frontline target. Its financial sector, which had been positioning itself as a fintech hub, is now dealing with disrupted banking operations and departing international firms. Bahrain does not have the reserves of Abu Dhabi or the sovereign wealth fund of Kuwait. A prolonged conflict threatens its economic viability in a way that larger Gulf states can absorb, but Bahrain cannot. What connects all 8 of these stories is a single structural lesson. Dubai did not fail because of a military defeat. It did not fail because of an economic flaw. It experienced the one thing its entire model was designed to prevent: uncertainty. And when uncertainty arrived, the money did what money always does. It moved. The question now is not whether Dubai recovers. It will. The Emirati government will offer incentives, visa extensions, and bailout packages that will bring some capital back. The question is whether the premium that Dubai charged for certainty, embedded in every real estate price, every financial license, and every corporate headquarters decision, can ever be restored to its pre-war level. Because the lesson the market just learned is that geography is not optional, and a city 100 miles from Iran was never as safe as it claimed to be. I will be tracking these capital flows as the conflict develops. If this kind of analysis is useful to you, subscribe to Geolensian. I will see you in the next one.